Hello guys, welcome back to our another episode of insightful videos. Double tops and double bottoms are very reliable patterns to identify supply, demand and breakout zones. But do you know why some double tops and bottoms perform exceptionally well while others barely work? To answer this question, I have backtested plenty of these patterns under different market conditions to uncover what makes a quality double top or bottom respected by the price. I applied multiple methods to see if they could improve the reliability of double tops and double bottoms. I have discovered an interesting method using order flow to trade these patterns. In this video, I will simplify the best way to trade double tops and double bottoms with easy to remember rules and guidelines. If you are interested, show your support by subscribing to our channel and smashing that like button, especially if you are new here, because we publish a lot of insightful videos like this along with the regular market analysis videos. So let's start by explaining double tops. A double top is a bearish reversal pattern that occurs at the end of an uptrend. It happens when buyers gets exhausted and the upward momentum slows down. You will see two tops in the same area with a valley in between. According to textbook rules, the tops don't have to be perfectly equal, but as long as they are around the same height, they are valid. We draw a line at the lower end of the valley, which becomes the neckline of the double top, and the price breaks below this neckline. It's a good area to enter a short trade. The price target is typically the same distance as the height between the tops and the neckline. The ideal stop loss is just above the breakdown candle at the neckline. Coming to double bottom, a double bottom is a bullish reversal pattern that occurs after a downtrend. It consists of two recent bottoms in the same area with a peak in the middle. Once the peak high is broken, it signals a long trade with stops placed just below the breakout candle at the peak high. The challenge with the double tops and double bottoms is that many times there are shake-offs or the entries occur after a significant trend, causing you to miss much of the market moves. To address this issue, I have developed a reliable method using order flow to identify shake-off and enter trades early. To trade double tops and double bottoms using this order flow method, you need two essential skills. First, the ability to spot the recent tops and bottoms in the market, and second, a basic understanding of how to read a order flow chart. Since we have already discussed the first one, let's move on to the second one, reading order flow chart. Order flow chart is a powerful tool for analyzing the real-time market orders driving the market. So let me break down using this candle for example. On the right side of this candle, you see the market buy orders that were executed against the limit sell orders in the order book. On the left side, you have market sell orders that are getting executed against the limit buy orders. Now here's the key. When there are more market buy orders than the limit sell orders, the prices will likely move up, and if there are more market sell orders than the limit buy orders, market will try to go down. It's all about understanding the battle between market orders and the limit orders happening live. Once you grasp this, order flow charts can reveal invaluable insights into the market movements. Now that we have covered the basics of order flow, let's take it a step further. First, we will use it to identify shake-offs in the market, those clever traps set by smart money to mislead the retail traders. Once we mastered that, we'll move on to the spotting early entry opportunities that give you an edge over the price action setups. Here I'm taking this double top for example. We have one previous supply here and another supply somewhere on the next day, and let's analyze what has happened around these supply zones so that we'll get a better understanding of how to trade these double tops or double bottoms. In the first spike, what happened, if you look at, there was a strong buying on right side, which speaks about the up move itself is because of strong buying market orders. So as the prices is going up, and the delta is also telling us the same with the strong buying imbalances. But at the same time, if you look at in order flow, both market orders and limit orders has to be there, which means the right side orders moves the market, at the same time left side orders they support the market. So for any kind of ideal move, both side there has to be a good volume, so mainly around the tops, and price also has to close according to the how the orders are coming in. So if you focus in the first top here, there were good volumes on the right side, but on left side there is not much of volume. In an ideal scenario, it has to be more or less equal. So if it is 1.2k here, it has to be somewhere around 1000. It can't be like 556. Same thing here, 1.3, 258, 1k strong market order, but at the same time 157. So this says that the left side orders are not very much interested to buy at higher prices. So what we discussed, left side is market sell orders and also limit buy orders. So if the limit buy orders are not interested, that means they are not interested because they are not very confident at higher levels. A limit buyer always want to buy at lower prices, so they are not interested at this price, so the prices came down. Again, let's look at what happened in the second spike. There was a strong opening around the previous day balance, and then prices made a strong spike, and the delta itself is negative delta 1.1k. This indicated higher prices attracting strong sellers, and likely even if the prices goes upside, these sellers, they will try to enter, but the prices have not gone up. But if you look at on the next candle what is happening, but as the price is coming down, you will see the stronger volumes on the lower side here, and look at where the price is closing. The price is also closing below the strong selling imbalances. So this says that these sellers are trying to take control very strongly, but that is not the entry point. Let's see what happens next. So next, the buyers try to take control. There was a positive delta, and then later again, despite of green candle, there is a negative delta indicating there is a bearish divergence. So what happened next is the price is breaking below this, whatever first the 15 minutes is there, it has breaking below, and prices have closed below that. If you look at the breakdown candle of first 15 minutes, what happened here, there are strong imbalances on the left side and price is closing below that. So this indicates some people are aggressively shorting it here, and look for shorting opportunities once this low is broken, keeping a stop loss ideally above the imbalance highs. So once you get a 115% move of your stop loss, then trail stop it to the previous 5-minute candle or imbalances if you have in that candle on the left side. So this is with double tops, and let's look at another example in double bottoms. So here in this method, what we look at is because the market is moved by these market orders, we look at the exhaustion from these people. Here we can take this as a double bottom. So what happened, there was a bottom here first somewhere around 10 o'clock in Nifty, and then we have a peak, and then again we have another bottom, and we can take this as a shake off. So look at the first bottom here. What happened on left side, there is a strong market order 1k. As the price is making lower low, there is not much of equal order on the right side. So that indicates the passive sellers are not there on the right side. So again, let me tell you, these passive sellers are also the market buy orders. So why the market buy orders are not there at the lows? Because limit orders are not there at the lower level. So these buyers are chasing the higher prices. And look at how the price is closing. There is a 1.1k delta. Despite of this strong negative delta, prices is closing within the previous range despite of a lower low. So what happened, there was a peak high, and then prices again came down. As the prices is coming down, so what happened, so here there is a 2k strong market sell order, but despite of this strong 2k sell order, the prices have closed above the opening price, and the delta itself is a 895. So this is an indication there is a divergence here. And look at on right side also, there is not much of order that is more or less equal to this left side order. So that indicates limit sellers are not ready to sell at the lower prices, so the buyers are chasing the higher prices. Now coming to the entry points, for any kind of longs, you look for buying imbalances on the right side, and that imbalances indicates there is a strong institutional presence, big orders are coming in, and prices has to close above that, and there has to be a zero on the right bottom side. So once the previous high is broken above this imbalance candle, it is going to be an opportunity with a stop loss below the imbalances. So once you enter, once the prices moves by 150 to 200%, you book most of your positions and try to trail stop it to the previous candle low or previous imbalances. So this is one more double bottom I am taking. So if you look at, there are two bottoms. There is a shake off around this area to take out whatever weak hands are there previously. So what happened here? Let's look at the first bottom. 1.7k sell order was there previously, and delta is negative, lower low is there. Despite of strong 1.7k sell order, there is not much of right side volume. This indicates the passive sellers are not interested at the lower levels. So next what happened? So there is a clear divergence and the price is closing above these strong volume clusters, indicating absorption in the first bottom. And then let's look at the next bottom. What happened? Same thing, as the prices started making lower lows, so there is a 990 sell order, but there is not much of equal order on the right side, and there is a zero here. So despite of strong selling order, look at where the price is closing above the selling order. So this indicated possibly it could be a shake off. Now just because there is a shake off, or just because there is no right side order, you never take a trade. So let's look at where we have a strong buying imbalances. There is a strong buying imbalance, 87 against 14, and prices has made a higher high. Here you have a zero on bottom corner, and somewhere around 3 candles later we have a clean breakout. So you can take a trade either here or here, keeping a stop loss just below this imbalance area. So once the prices moves by more than 150 to 200%, book most of your positions and then trade stop it to the previous candle lows. So carry the rest of 25% or 30% of your positions as long as the prices goes upside. There are many ways where you will want to exit. You exit once you get a fixed amount of target, or you exit at once the previous peaks has been reached, you can keep them as target and you exit. Or other thing is, since you have already booked at 150% to 200%, once you see selling imbalances or the previous candle is closing below the previous 5-minute candle, you can exit. So this is with combining both order flow and double tops and double bottoms, guys. I hope I have added some value to your trading. To make this strategy much more trustworthy, try to analyze as many charts as possible. Don't try to look at only 2 or 3 charts and immediately jump into trading. Look for 50 to 100 charts, then you will get a better idea how to trade those setups. Thank you. Have a nice day, guys.